Welcome to my book library. Settle in, find a comfortable space, and prepare for a deep and transformative journey. Today, we are not just summarizing a book, we are unpacking a new way of thinking about one of the most powerful and emotional forces in our lives, money. The book is Morgan Housel's The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. Over the course of this session, we will move beyond the cold hard numbers of finance and into the warm, messy, and fascinating world of human behavior. We will explore why a brilliant scientist can be terrible with money, and why a high school dropout can build a fortune. The answer, as Housel masterfully argues, lies not in intelligence, but in behavior, in mindset, and in the unique stories we all carry about what money means. Our journey will be comprehensive. We will walk through each of the book's core ideas, spending significant time on the nuances, the real-world examples, and the practical implications for your own financial life. This is designed to be an immersive audio experience, giving you the full depth and detail of Housel's work. So, let's begin this exploration into the psychology of money. Part 1. The Foundation: How We Think About Money. The first part of the book establishes a crucial premise: that financial decisions are not made in a vacuum of pure logic, but in the complex theater of our personal history and psychology. Chapter 1. No One's Crazy. The chapter opens with a powerful idea. Your personal experiences with money make up maybe 0.01% of what's happened in the world, but they form 80% of how you think the world works. Consider two investors, one who started their career in the booming bull market of the 1980s and 90s, and another who entered the workforce during the financial crisis of 2008. The first learned that stocks always go up. The second learned that the economy is fragile and dangerous. Both are operating on logic derived from their own lived reality. When someone makes a financial decision that seems insane to you, it's not because they are foolish. It's likely because they have lived a life you haven't, with lessons you haven't learned. Understanding this is the first step to financial empathy, both for others and for yourself. Chapter 2. Luck and Risk. Here, Housel introduces the sobering twins of luck and risk. He tells the story of Bill Gates. While Gates is undoubtedly brilliant and driven, he also attended one of the few high schools in the world that had a computer in 1968. That was an incredible stroke of luck. For every Bill Gates, there is someone just as smart and hardworking who happened to be in the wrong place at the wrong time, or who took a similar risk and failed due to an unforeseeable event. The lesson is profound. We must be cautious about drawing too clean a narrative from individual success stories. We see the winners and often mistake their luck for a reproducible formula. Similarly, we must have compassion for failure, as risk often plays a role. The key is to focus on broad patterns of success, like frugality and patience, rather than idolizing any single individual's specific actions. Chapter 3. Never Enough. This chapter tackles one of the most destructive forces in finance: the inability to define enough. Housel shares the tragic story of Rajat Gupta, a man who had reached the absolute pinnacle of corporate success, a former CEO of McKinsey, a man with a net worth in the tens of millions. Yet he risked it all: his reputation, his freedom, for the potential of a few more $1 million through insider trading. He didn't need the money. He was caught in the trap of more. Housel argues that the hardest financial skill is getting the goalpost to stop moving. Knowing when to stop, when to say, "This is sufficient for the life I want," is a critical defense against catastrophic errors. Greed is not about wanting more, it's about risking what you already have and need for what you don't have and don't need. Chapter 4. Confounding Compounding. We all know the mathematical concept of compounding, but Housel argues we fundamentally underestimate its power in practice. He uses the ultimate example, Warren Buffett. Buffett's skill as an investor is exceptional, but his secret is time. He started investing seriously in his early teens and has been relentlessly compounding for over 3/4 of a century. The stunning fact is that the vast majority of Buffett's wealth was accumulated after his 65th birthday. The lesson is not that you need to be the best investor, but that you need to be a good enough investor for a very, very long time. The magic happens in the last few years, but it only happens if you stay in the game for all the years that came before. It's about consistency and endurance, not flashy brilliance. Chapter 5. Getting Wealthy versus Staying Wealthy. Housel makes a vital distinction between the two skills. Getting money often requires risk-taking, optimism, and a bit of bullishness. It's about taking a chance, but staying wealthy requires a completely different mindset. It requires humility, fear, and paranoia about all that could go wrong. Getting money is an offensive game. Keeping money is a defensive game. Many people who are good at the first are terrible at the second. The key is to recognize that the world is unpredictable and random. Your strategy for staying wealthy must include a robust margin of safety to survive the inevitable surprises that the universe will throw your way. Part 2. The Practical Behaviors. Building a Resilient Financial Life. This section moves from philosophy to action, outlining the specific behaviors that lead to long-term financial resilience and freedom. Chapter 6. Tails, you win. In many fields, a tiny number of events account for the majority of the results. A venture capitalist might invest in 100 companies. Just 1 or 2 will generate all the returns, while the rest fail or break even. This is the power of extreme outliers or tail events for an individual investor. This means that a very small number of investments in your lifetime, maybe 1 or 2 stocks or the decision to buy a house in a specific area, will be responsible for the vast majority of your net worth. The strategy then is to be okay with a lot of things not working out. You don't have to be right all the time. You just have to be right a few times and make sure you don't bet so much on any one thing that a wrong decision can wipe you out. Chapter 7. Freedom. This chapter presents what may be the book's most powerful idea. The highest dividend money pays is not the ability to buy more things, but the ability to control your time. The ultimate luxury is waking up in the morning and having the autonomy to say, I can do whatever I want today. This ability to control your own time is, for many, the most valuable return on investment they will ever earn. It shifts the purpose of wealth accumulation from consumerism to autonomy, from displaying status to purchasing freedom. Chapter 8. Man in the Car Paradox. Have you ever seen someone driving a luxurious, expensive car and thought, wow, that person is so cool? Housel points out the paradox. That person in the car thinks you are admiring them, but in reality, you are probably just admiring the car. No one is impressed with your possessions as much as you are. We spend immense sums of money on status symbols, hoping to gain the admiration of others, when in fact, that admiration is often misdirected towards the object, not the owner. True respect and admiration are earned through traits like kindness, integrity, and generosity. Things money can't buy. Spending money to show people you have money is the fastest way to have less money. Chapter 9. Wealth is what you don't see. Expanding on the previous idea, This chapter drives home a crucial point. When you see a person with a flashy car or a big house, you are not seeing their wealth. You are seeing what they spent. True wealth is the hidden part, the unspent income, the savings, the investments quietly compounding in the background. Wealth is financial assets that haven't yet been converted into the stuff you see. It is the gap between your income and your ego. The most impressive financial stories are often the most invisible. The person living in a modest house who has complete financial independence because they have spent decades living below their means. Chapter 10. Save money. Housel frames saving not as a mathematical necessity, but as a standalone, critical behavior. You can't predict the market's future returns, and you can't control the global economy. But you can almost always control your savings rate. Saving is the one factor of financial success that is entirely within your personal control. And you don't need a specific reason to save. Save for the unknown. Save for the opportunities you can't yet foresee. Save simply for the flexibility and security that a large cash cushion provides. A high savings rate is both an offensive tool for building wealth and a defensive shield against life's unexpected blows. Chapter 11. Reasonable over rational. The world of finance often pushes us to be perfectly rational, like a cold, calculating robot. But humans are emotional beings. Housel argues that it is far more effective to be reasonable than to be perfectly rational. It might be mathematically optimal to invest every spare dollar in the stock market, but if that causes you constant anxiety and sleepless nights, it's an unreasonable strategy for you. It can be perfectly reasonable to pay off a low-interest mortgage early for the psychological peace of mind, even if the numbers say you could earn more by investing that money. Your financial plan must survive your own psychology. A reasonable plan that you can stick with is infinitely better than a rational one that you will abandon at the first sign of trouble. Chapter 12. Surprise. And Chapter 13. Room for error. These two chapters are deeply connected. Housel argues that history is largely the study of surprising, unexpected events. Yet, we are terrible at forecasting because we tend to extrapolate the recent past into the future. Therefore, the single most important part of any financial plan is building in a margin of safety. This means planning for your plan to not go according to plan. It means having more cash savings than you think you need. It means assuming your investment returns will be lower than the historical average. It means being more conservative with debt than the bank says you can be. Room for error is what allows you to endure the inevitable surprises, the job losses, the market crashes, the personal emergencies, without your entire financial life collapsing. It is the humility to admit that the future is uncertain and the wisdom to prepare for that uncertainty. Chapter 14. You'll change. We are all terrible at forecasting our future selves. The person you are at 25, with your specific goals and desires, is not the same person you will be at 55 or 75. This is a major challenge for long-term financial planning. Locking yourself into a rigid, unchangeable plan based on who you are today can be a recipe for future regret. Your future self might value freedom and flexibility far more than a large house. Chapter 15. Nothing's free. Everything of value has a price, but in investing, the price is not always a dollar amount. The price of higher returns in the stock market is volatility and the stomach-churning fear of watching your portfolio plummet during a crash. The price of missing out on a hot new investment is the potential for regret. The key is to acknowledge these hidden, non-financial prices and to be willing to pay them. If you want the long-term growth of stocks, you must be willing to pay the price of periodic downturns. If you want the peace of mind of guaranteed returns from a savings account, you must be willing to pay the price of lower long-term growth. Every financial strategy has a cost. The trick is to find one whose costs you are emotionally willing to bear. Chapter 16. You and me. We are all playing different financial games with different goals, time horizons, and rules. A day trader is playing a game of short-term price movements. A 30-year index fund investor is playing a game of long-term economic growth. It is a critical error to take financial advice or cues from someone who is playing a completely different game than you are. Don't let the day trader's panic or excitement influence your decades-long strategy. Define your own game, your own goals, your own timeline, and stick to it, ignoring the noise from those on a different playing field. Chapter 17. The Seduction of Pessimism. Throughout history, pessimists have sounded smart and optimists have sounded naive. But the long-term arc of human progress is overwhelmingly positive. Why is pessimism so compelling? Because it's rooted in loss aversion, the psychological principle that the pain of losing $100 is far more intense than the pleasure of gaining $100. This makes negative news and dire predictions feel more urgent and intelligent. However, for an investor, long-term optimism is not just hopeful. It's the most reasonable stance, backed by centuries of economic data. Don't let the seductive, smart-sounding voice of pessimism talk you out of a long-term, optimistic strategy. Chapter 18. When you'll believe anything. This chapter explores the link between desire and belief. The more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. This is the psychological engine behind financial bubbles and get-rich-quick schemes. When you desperately want to become wealthy quickly, you will be drawn to stories of people who turned a small sum into a fortune, and you will ignore the overwhelming odds against it happening. Your wants can distort your beliefs, leading you to take enormous, unjustified risks. Part 3. The Synthesis, a Cohesive Philosophy. Chapter 19. All together now. This chapter is not a new idea, but a weaving together of all the previous themes. It shows how luck, risk, compounding, frugality, and a margin of safety are not isolated concepts, but interconnected parts of a single, robust financial philosophy. It reinforces that financial success is not about finding one magic bullet, but about building a system of good behaviors that work together to help you survive and thrive over the long term. It's about taming your own ego, defining what enough means for you, and having the patience to let compounding work its slow, quiet magic. Wealth is not about the cars you drive or the houses you buy. It is about the unseen asset, the unspent money that gives you control over your time and your choices. It is built not on a foundation of supreme intelligence, but on a foundation of simple, good behavior, living below your means, saving relentlessly, being patient, and leaving a wide margin for error. Go forward and apply this wisdom. Manage your behavior as diligently as you manage your portfolio. Build a financial life that is not just rich, but resilient, flexible, and aligned with your personal definition of happiness. Thank you for your valuable time and for listening to this comprehensive audio summary in my book library. Thank you.